So good morning, everyone. It's a real pleasure to be here today to present to you on sustainable investing. And in this session, I'm going to give you a whirlwind tour of sustainable investing. I'm going to cover the trends that are driving demand. I'm going to give you a high-level overview of the regulation relating to ESG in Europe, talk through some of the observations and challenges that we see, look at how retail investors think about ESG and how financial advisors are embedding sustainable investing within their processes. And finally, I'll touch on ESG and fund managers. So there's a lot to cover, so I'm going to dive straight in to the trends. So the ESG landscape has definitely been taking central stage in the investing world over the past few years. And this has been driven by a few different reasons. So firstly, the changing societal landscape. So, COVID-19 has had a real impact, and we've seen a shift to focus more on, societal consciousness. We also see evolving investor preferences. So we see investors much more focused on issues like climate change, diversity and inclusion, and good governance, which reflects a lot of, what we see and hear on the news. And then there's enhancing investment performance, so risk mitigation from an ESG perspective, and investor engagement and activism is becoming more prevalent. And then, changing regulation and policy, which is the most prominent of all. And we see in the EU Action Plan, taking up a lot of energy for the industry. And I'm going to be talking about that a little bit later on. So I just want to illustrate the growth in that customer demand and awareness. A key finding in a report called the Eco Awakening Report that came out of the Economist Intelligence Unit, and that was commissioned by the WWF, shows that a staggering 71% rise in online searches for sustainable goods since 2016. And, this demand is not just coming from consumers in high income countries, but it's also strong in both developing and emerging economies. So I'll give you a couple of examples. There was an increase of 24% in Indonesia and a huge rise of 120% in Ecuador. In the US, Google searches for sustainable products grew by an astonishing 450%. Between 2016 and 2018. So, there's real demand. And then in terms of those investor preferences, I wanted to introduce you to some investor personas. So these personas are based on some research that was run by a company called Boring Money. They run an annual survey on retail investors' sustainable preferences. And these personas here represent the UK investing public, and they were based on surveying over 4,000 consumers that were either invested or had savings. And I think the sort of key thing to point out here is that 2 of the 6 personas actually are prioritizing sustainability over returns. And even of the 4 that are prioritizing returns, 3 out of 4 of those have an interest in doing so with a sustainable focus. So one of the other drivers I talked about was risk mitigation to sort of drive performance. So here I wanted to highlight the impact of ESG risk on a company's share price. There's a lot of different examples that I could have picked, but I chose Boohoo. It's an online fashion group. Boohoo found itself at the center of a media storm around its supply chain and social policies, which you can see impacted their share price. And I also wanted to mention that, in the survey I just spoke about, investors actually called out specific companies that they wanted to avoid within their portfolios, and Boohoo was one of those. So this also picks up on that trend of societal consciousness, where investors are looking to avoid companies with poor social policies. So to sort of round off this section on the trends and neatly segue into regulation, I just wanted to illustrate the huge rise in ESG policy and regulation globally. And obviously in Europe, that has been primarily focused on the EU Action Plan. So now let's focus on what that looks like in Europe. So the EU Action Plan, the EU is in the middle of of a major project to sort of leverage financial markets to address the sustainability challenges, particularly global warming, and the legislations and directives are at different stages of development. But overall, the plan aims to reorient capital flows towards a more sustainable economy, mainstream sustainability and risk management, and foster transparency and long-termism. Now, that may sound a bit jargony, but I guess an easier way to say it is, the EU wants more people to put their money into sustainable products because they consider sustainability factors as they make those investment decisions. And by changing the investing culture, it puts a stronger onus on corporate CEOs to think, much more long-term about the sustainability of their operations. So it's a 10-point action plan, but right now the industry is primarily focused on number 1, taxonomy, which is about reporting on alignment to a set of 6 different sustainable activities. But right now it's starting with climate action and climate change. Number 4, which focuses on introducing sustainability within the advice process. And number 5, which is around developing sustainable benchmarks. So this includes new climate change benchmarks and disclosures on ESG factors for indexes. And number 7, which relates to Esg and Investment Management. And this is, primarily around disclosures and reporting. So, I'm going to give you this really high-level view of what product managers need to do. Product manufacturers. They need to integrate and monitor sustainability risks within their investment processes and communicate this to the outside world. They then need to disclose their sustainability considerations for their sustainable products. So these are labeled 8 and 9, and I'll talk a little bit more about that in a minute. And then they need to report on their disclosures both at a product and an entity level. And then in terms of what do those giving advice need to do? So the wealth managers and advisors, similar to the product providers, advisor and wealth firms will need to integrate sustainability risk into the business and disclose on how they do this. When it comes to the advice changes to MiFID II, and that's actually coming next week on the 2nd of August, it means that advisors need to understand their clients' sustainability processes, sustainability preferences, and include those within the suitability process. They'll then need to advise on the right solutions, communicate to the client on how that fits with their preferences, and obviously monitor those solutions as part of an ongoing service. So again, like I said, what I've been through is very, very light touch, and we could do a whole session on just one aspect of these requirements, but hopefully that's giving you the headlines. Now, sticking with the theme of regulation, I'm just going to go on to what we're actually observing in the market from a regulatory perspective. So I mentioned the Article 8 and 9 funds earlier. So these are the prospectus disclosures where a fund has to disclose if they're an Article 6, 8 or 9. And this regulation came into effect in March 2021. But the additional reporting and additional data points, like considerations of principal adverse impacts and sustainable minimums, don't necessarily need to be disclosed until January 2023. So let me explain what these classifications mean. So Article 8, this is more general ESG, and it's defined as funds that promote environmental or social characteristics, and they tend to be considered light green versus Article 9 funds. And these tend to have a sustainable investment objective and are considered darker green. And then Article 6 just refers to managed products. So I wanted to give you a few examples of the different approaches. If we look at Article 8, the Article 8 category is really a bit of a catch-all category. There's a wide range of products applying a variety of different ESG approaches, which you'll see listed here. So it can range from exclusions only, ESG integration and engagement, KPIs such as potentially achieving a higher ESG aggregate score or a lower carbon intensity than the benchmark. And some Article 8 don't even have a binding constraint and may just consider ESG factors or engage with companies, but they can also, take a best-in-class approach or have a thematic approach, like, for example, clean water. Whereas the Article 9 category, which, as I mentioned, is considered dark green, these tend to invest in companies offering products and services that are deemed to contribute positively to society, while making sure that companies don't do significant harm and tend to follow good governance practices. And as a result, the majority of Article 9 funds have a thematic approach or an impact focus, and could often be aligned with one or more of the UN Sustainable Development Goals. So that's the backdrop. Let's have a little look at the inflows. So as you can see, inflows into Article 8 and 9 funds have overall accelerated. And, this is driven by that sort of increased investor interest in sustainability issues, and also the high number of options that are available. You can see that over 2021, Article 8 and 9 funds had really strong inflows. They captured 57% of total inflows in the third quarter and 44% of inflows in the second quarter. It's fair to say that this now we're looking at the fund launches, that the regulation has been a real catalyst for product development. We've had over 800 funds launched as either in Article 8 or 9 since they've been introduced, and that's almost half of EU fund launches that we've seen. Now, it's not just about the fund launches. If we look at rebranding and repurposing, over 3,000 funds have been repurposed as an Article 8 or 9 fund. And you can see the huge spike in Q1 last year when the regulation was introduced. I wanted to show you that if you take these funds and you look at them compared to other metrics, so in this instance, I'm looking at them compared to the Morningstar sustainability rating, Article 9 funds, over 70% of them have a 4 or 5 globe rating. That compares to 52% of Article 8, with just 34% of Article 6 funds getting a 4 or 5 globe. And the fact, I think there is a lower percentage of Article 8 than Article 9 funds with 4 or 5 globes reflects the broad spectrum of green that investors will find represented in that Article 8 category. And that really does mean that investors will really need to do their due diligence and make sure that they understand the nuances between the ESG approaches and the different shades of green. Now, looking at Article 8 and 9 funds through the lens of ESG metrics, we found, as you probably would expect, that Article 8 and 9 funds are less exposed than Article 6 funds to controversial activities and products, and Article 9 funds tend to have a lower exposure than Article 8 funds. What might be surprising to you is that the exposure of Article 8 and 9 funds to thermal coal and fossil fuels, so particularly in the case of Article 9, where products under the SFDR sort of have a do no significant harm requirement applied. And I think some of this is what is triggering some of the greenwashing allegations. But despite this, Article 9 funds with fossil fuel exposures are technically not in breach of SFDR, provided that the asset managers comply fully with the applicable disclosure requirements. So I'll leave it there on the regulation piece. So now I'd like to sort of move it on to some market observations around data. So I wanted to talk about some of the challenges and what we're seeing. So, it definitely is a confused and crowded marketplace. There's many providers, and there are multiple sort of acquisitions and mergers and new participants emerging. So it's a real challenge for the industry to understand what's available to them and where to get it from. And it's not only, I guess, the quantity and of providers out there, but it's the quantity and quality of the actual data that is being disclosed. So over the past decade, we've seen an increase. I mean, it's a huge amount of data, from like 1 million to 14 million data points, which is incredible. And only 25% of the data is numeric and the rest is lagged and unaudited. So it's very difficult to compare. And, customers of the data will have varying needs from, that there's, sophisticated to simple. So, we at Morningstar Sustainalytics are doing a lot of work sort of helping clients to navigate that data and use what's most appropriate to them based on their specific use case. So I now want to move it on to financial advisors and ESG. And I'm going to bring you back to my favorite personas, the retail investor personas. And ultimately, these are the people that the advisors are providing advice to. And, as you can see, one size does not fit all, and investor personas have different requirements. So I just want to walk you through these personas. So our eco warrior, this investor cares about the environment and climate change. Our future focus has a wider sustainability focus and is looking to secure a sustainable future for their family. The moderate greens are focused on returns, but they want to achieve those returns whilst having a positive impact with their money. Our diligent savers are focused more on stewardship. So again, they want to, they want to achieve those returns, but they want it to ensure that they do so with products that are well governed. And our no nasties want to avoid sin stocks. And even if you look at the pure return, whose only focus is really performance, they will have an interest in ESG from a risk mitigation perspective. The retail investors want to know how their investments are sustainable. They're concerned about greenwashing. They want to know what is the investment trying to do, and they need simple and easy metrics to be able to understand that. And this is where, I think the regulation creates a bit of a disconnect and a challenge for advisors in the industry. So the regulation requires advisors to implement sustainable preferences into their advice process. However, the regulator's view of understanding sustainable preferences are based on taxonomy alignment and the minimum portion of, and or whether a product is an Article 8 or 9 and the minimum sustainable portion, and whether or not a investment considers principal adverse impacts. So these are pretty technical terms, and the industry has been sort of grappling to get their head around all of this and to manage that. So now the advisor has to ask the end investor to make a decision about how they want their investments to reflect these specifics. So it is complicated. So the advisors are challenged with trying to figure out how to explain those technical terms, and they have to manage some of the gaps in the data availability, which I think I touched on a little bit earlier. So as I mentioned, there is a huge amount of data in the market, but the regulator's definition is very specific, and the deadline for some of that data to be available is later than the implementation of this advice rule. So, there's a lot to grapple with. But ultimately, the advisor needs to understand the client's preferences. They need to sort of take those preferences and map the data that is available today to meet those preferences, and then they need to be able to communicate the portfolio or the investment advice and how that meets the client's investment goals. So I'm now going to move on to the final part of the presentation to talk about ESG and fund managers. So when it comes to ESG investing, we've already talked about this, there are multiple approaches, but at Morningstar, we tend to look at it through, two key lenses, trying to keep it simple. So improving investments by avoiding ESG risk that could impact a company's value. And on the flip side, looking to identify ESG opportunities. The other lens looks at improving the world. So this is where investors may want to have a positive impact, which could be something like alignment to the UN SDGs on the world, or target a specific theme like renewable energy or clean water. And these themes are typical of what you might see in the market. So if you remember the slide I showed you on the different Article 8 and 9 approaches. Now, in our experience, asset managers can be at different stages in their approach of integration of ESG within the business. And to provide some insights to the market, we launched the Morningstar ESG commitment level. This is a qualitative assessment that covers both asset managers, but also investments. The rating looks at 3 different pillars. So number 1, we look at a firm's philosophy and processes. We're looking to see if a firm articulates a clear philosophy that it's incorporating into its investing principle. Secondly, we look at the resources that they have at their disposal. In some cases, having separate teams of ESG experts who can provide support to investment teams can make sense. In other cases, ESG expertise resides within investment teams. And then, finally, we look at their active ownership. So we evaluate the extent and effectiveness of a firm's engagement and proxy voting program to advance sustainability goals. There are 4 outcomes, 4 levels of ratings. We have leaders. So these are the very best at incorporating ESG principles into the investment programs. They clearly articulate their ESG philosophy, fully incorporate ESG analysis into the investment process, and they tend to run best-in-class engagement and proxy voting programs. The advanced level sits just below leaders, but we would still consider them to be amongst the better ESG offerings and managers. The basic level, this tends to be more like sort of where, a degree of ESG incorporation is in place. So, for example, maybe they don't have a strong, ESG investment personnel or data at their disposal. And then low, these are asset managers that are either not integrating ESG into their investment processes, or they're doing it in a really limited way. So I thought you might want to see how this breaks down. As I mentioned, it's a qualitative assessment. So as of the end of February, we had 80 fund managers covered. Only 10% make it to leaders, 19% are advanced, 40% basic, and 31% are low. I've also, highlighted some examples of each of those buckets, but I thought it might be interesting to just sort of dig into a couple of them. So let me talk about LGIM and why they are a leader. So LGIM has positioned itself as a sustainability champion, particularly in the area of investment stewardship. So ESG is integrated into their investment process where possible, but a large portion of their assets are actually passive. So this puts the focus on the value of active ownership. And this is an area where LGIM is ahead of its peers. LGIM has long made voting and engagement core to its investment approach, and continues to, to set best practices in this area. It's also, LGIM also has a really strong, experienced team. And they have a structured, centralized process for engaging with portfolio companies and voting. And then at the other end of the spectrum, so let's take Vanguard, that have been rated as low. So, ESG strategies do have a long history at Vanguard, but they only amount to a fraction of assets under management. And they mostly use negative screens to exclude companies in controversial industries. So Vanguard's active ownership efforts for its passive strategies still have a lot of potential, but the team isn't really large enough given Vanguard's global scale and AUM and its support of key ESG resolutions. It is improving, but it still remains low. So as on this final slide, I just wanted to give you an example of a report. So you can see it's qualitative. It's basically describing the pillars I went through and Morningstar's view on the firm, and provides the reader with, what we really think about an asset manager's ESG strategy. So that brings me to the end of the formal presentation, but I just wanted to add a couple of more general points. So as we've just heard, ESG investing is multifaceted and introduces investor objectives that range from, managing risk to promoting societal impact. And these considerations create new opportunities and trade-offs that investors can choose. ESG is not black or white, and one size does not fit all. And as a result, ESG and ESG data and rating providers have faced criticism, and Morningstar has faced some of these same criticisms. We pride ourselves on the independence and transparency with which we operate and conduct research. So we've engaged in open dialogue with different groups, and we also commissioned a review from a third-party firm, White & Case, to ensure our ESG research lives up to our standards of objectivity, consistency, and transparency. We're in the process of adopting each of the recommendations made by the third-party assessment and expect to complete that by the middle of next year. We'll continue to seek feedback from the industry with open minds so that we can keep raising the bar for the work we do on behalf of investors. And with that, I'd just like to thank you for the opportunity to present today.